Dividend growth investing during market declines. It's a kind of interesting article I got off Advisor Perspectives. I get stuff all the time sent from various firms and whatnot, and I don't know, you got to do your own due diligence. But I thought this would be of interest. I share it with you. I'm always a fan of dividends. I mean, I've said that till I'm blue in the face. Dividends are fantastic. Without question, dividends are a critical part of a successful investment program. That's not debatable to me. Now, whether or not dividends will continue to be, no one knows. We just don't. They don't. But this is pretty interesting. Dividend growth investing, dividend growth in times of turbulence. Why are dividend aristocrats king? I'm trying to make this bigger, but I can't make it bigger. I don't know why. So, there we go. Dividend growth strategies held up. Well, now I can't see. Am I still on here? There we go. Okay, cool. Dividend growth strategies held up better than the broader market during the recent downturn and also had the consistent growth to perform in rising markets. The key is quality. Dividend growers generally had the financial stability to weather market turmoil. While the S&P 500 declined more than 13% during the 3-month period from October 1st, 2018 to December 2018, dividend growth strategies fared far better. And that wasn't limited to domestic large caps. It also applied to mid and small caps as well. And I'm always a big fan of these kind of charts here where they're doing the up capture and the down capture. All right, so what that means is the S&P 500, we start with 100. It goes up 50%. That means it goes from 100 to 150. If your up capture is 90%, you're going to go from 100 to 140. You get, or no, 145, excuse me. You get 90% of the up of the S&P 500. So this S&P's at 100, goes up to 150. You're at 100, you go to 145. You get 90% of the up, right? Something like that. Yeah, 90. Now, the downside capture is actually more illuminating to me because if the market's down 50, if it goes down 50% from 100 to 50, and you only go down 25%, your downside capture is 50%. So you're only getting 50% of the loss, yet you're getting 90% of the gain. Now, you got to be careful. I mean, it's a 3 months and whoop-de-flip and do. But still, the capture is quite important to understand. And they'll show it right down here, actually. This one goes back to 2005. That's sweet. All right, so here's the S&P 500 Dividend Aristocrats Index versus the S&P. So on the upside is up 91.97. So if the S&P is up to 200, you're up. I don't even know what that'd be. It's 92%. But when the S&P was down, you were only down 75% of what the S&P was down, if that makes sense. So you're getting 92% of the up with only 75% of the down, which I think is pretty cool. And that goes back to 2005, which includes the Great Recession. Not too shabby. And don't forget, that's when they had a lot of the big dividend companies were basically regulated to paying 1 cent per share. Why was a dividend stock only paying 1 cent a share? Anyone want to guesstimate that? Take a gander why that'd be the case? Because that way they could keep paying their preferred shareholders. As long as they pay the common dividend, even 1 penny, they must contractually obligate to continue to pay their preferred shareholders. Interesting. All right, so here's the S&P mid-cap dividend. We got a 5-year track record, almost 6 years it looks like. 99% of the up and 72% of the down. Again, that's not long enough to mean anything. I think that 2005 to 18 is. I mean, that gives you something to hang your hat on. But here's the Russell 2000 Dividend Growth Index. Again, that's going to be 4 or 5 years. 2000, about 5 years. 80 is that 80? It's 90. I can't tell. It's 80. No, it's 90. 95% of the up. That's 85% of the up and 50% of the down. So there you go. That's cool. I like that stuff for sure. I'm a big fan of the capture ratios. Here's the performance of the S&P Dividend Aristocrats during the market turmoil of the last quarter of last year. We were down 8.63. The S&P 500 is down 13. So basically 60% more was the S&P 500 down. Mid cap was even better. We're down half of what the S&P 500 400 mid cap was, and then the Russell was down, 40% of what the Russell 2000 was. That's pretty good. And then we got these things. I don't know what. I guess these are who are these guys? Pro Shares. This is their ETFs, and I don't know anything about them. The Noble. Since inception, 2013, expense ratio of 0.35. It just tells us the performance. So that, I mean, that doesn't tell me much, because we've had a nice little run since 2013, that's for sure. So anyway, that's of interest to me. I'm a fan of the dividends, Dividend Aristocrats. That looks pretty good to me. And if you want to put a link to the show notes, you can look at all their different ETFs they have on here. I have no idea about nothing about these guys. I just don't know. But it's a pretty good article. I like it. And again, I like dividends. And dividends is something you might want to look at to add to your portfolio. And where should it go? Of the three, we have the taxable, the tax deferred, and the Roth. And dividends should be in your Roth at all times, as Rex Kwon Do used to say when he's telling his the guys who are going to go training in the Rex Kwon Do in the Octagon karate. You know what I'm talking about, right? Napoleon Dynamite. We don't travel alone. We travel buddy at all times. If you haven't seen Napoleon Dynamite, my friends, do yourself a favor and go rent that sucker now. I will see you.